Welcome to This Explainer. I am thrilled to have you here today. Ever wonder how we take a raw, adjusted trial balance and transform it into a company's polished, official financial story? Well, you are in exactly the right place. We're going to look at the exact mechanics of preparing financial statements. Think of this as turning a pile of raw materials into a meticulously designed blueprint.
Let me throw a question at you right out of the gate. What actually happens after the books are closed? The controller signs off, the trial balance is finalized, and everyone breathes a massive sigh of relief. But the reality? The close is just the beginning. It's really the starting point of an accounting assembly line where we build the final deliverables that the outside world actually sees.
Here is our roadmap for the assembly line today. We'll hit the classified balance sheet, decode the income statement, track stockholders' equity, and finally, dig into the essential financial notes.
All right, stop number one, the classified balance sheet. This is our snapshot of the business under Standard ASC 210. Okay, let's dive into this. The balance sheet is literally the structural foundation of the business. But to build it right, everything we do from here on out has to comply with GAAP, generally accepted accounting principles. The whole goal here? Total compliance, and crucially, consistency. We aren't just slapping together a balance sheet for today. GAAP demands a comparative balance sheet, meaning we must show at least the prior period right alongside the current one. That way, stakeholders can actually see how the business is evolving.
Now, you hear the term classified balance sheet a lot, right? That simply means we are visually chunking the assets and liabilities into two highly specific buckets, current and non-current. So why does this matter? Well, it instantly tells banks and investors if a company can actually pay its near-term bills. Current items are the things turning to cash or requiring cash in the short term, like your accounts receivable or inventory. Non-current, that represents your long-term value and obligations, like property, plant and equipment, or a big multi-year loan.
And the magic number separating those two categories? It's 12. Current means it's expected to be converted to cash or settled within 12 months of the balance sheet date. Now, there is one pretty big exception to this classification rule. Sometimes banks and financial institutions prefer assets and liabilities to be presented simply in order of liquidity rather than strictly shoved into 12-month buckets. And hey, that is absolutely allowed under GAAP, but it has to be disclosed and applied consistently.
Real quick before we leave the balance sheet, I want you to pay super close attention to this warning. You absolutely must remember to reclassify the current portion of long-term debt. It is such a common trap. If you've got a 10-year loan, the payments due in the next 12 months have to be carved out and moved over to current liabilities every single period. If you skip this exact reclassification, you are severely understating the company's near-term obligations, which literally ruins the accuracy of your financial blueprint.
Moving right down the assembly line to Part 2, decoding the income statement.
So, while the balance sheet is a snapshot of a single day, this statement captures the daily operational grind over a period of time, and it brilliantly illustrates a waterfall effect. Just look at how the presentation steps down. We start way up at the top line with revenue, netting out any discounts. Then, we subtract the direct costs to find our gross profit. From there, we deduct our operating expenses, things like R&D and marketing, to get operating income. Finally, after a few more adjustments for taxes and other income, boom, we hit the bottom line, net income. It's this highly structured cascade showing exactly how a dollar of sales turns into a penny of profit. Under Standard ASC 220, there are a few key presentation rules you definitely need to know. First off, companies can use either a single continuous statement or a two-statement approach to show comprehensive income. Second, and this is a fun piece of trivia, unusual items are actually no longer called extraordinary items under US GAAP. They killed off that specific label in a 2015 update. And third, if a company makes a massive strategic shift, say selling off an entire division, those discontinued operations get their very own separate line to avoid muddying the waters of the normal continuing operations. Now, for public companies, the income statement also has to show earnings per share, or EPS. You're always going to see two numbers here, basic and diluted. Basic EPS is super straightforward math, just net income divided by shares. But public companies are also required to show diluted EPS. Think of this as the worst-case scenario metric for current shareholders. It basically assumes every single outstanding stock option, warrant, and convertible bond is turned into stock right now, showing investors exactly how watered down their slice of the pie could potentially get. Finally, we have to account for other comprehensive income, or OCI. These are very specific items that bypass the traditional income statement entirely. We're talking about unrealized gains on available-for-sale securities, cash flow hedges, pension adjustments, and foreign currency translation adjustments. Why do they bypass net income? Well, because they just haven't been fully realized in day-to-day operations yet. Instead, GAAP makes us park these items directly in equity, strictly net of tax. All right, let's move on and see how this builds in Section 3, Tracking Stockholders' Equity. This statement tracks the ownership deeds of the business. And make no mistake, it is a hard requirement for all GAAP financials, public or private. The core of it relies on a really simple mathematical roll-forward formula for retained earnings. It perfectly connects the income statement right back to the balance sheet. Step 1, you take the beginning balance of retained earnings. Step 2, you add in that net income we just calculated on the income statement. Step 3, you subtract any dividends declared. That final number, it drops right into the ending balance of the equity section. It is a beautiful, closed-loop system. Now, tracking equity can get incredibly complex the second a company starts buying back its own shares, which is known as treasury stock. There is a highly specific GAAP rule here you've got to watch out for. Under the cost method, if a company later reissues that treasury stock for less than it originally paid, the shortfall doesn't just vanish. It has to reduce additional paid-in capital, or APIC, first. In fact, it reduces APIC all the way down to 0 before it's ever allowed to touch retained earnings. Really goes to show you just how rigorous the tracking of every single equity dollar has to be.
And finally, we arrive at Station 4 of our assembly line, the essential financial notes.
You know, people so often treat the notes like a boring appendix tacked on to the end of a book, but notice the exact phrasing here, an integral part of the financial statements. Think of them as the rich architectural blueprints of the business, or maybe the director's commentary on a movie. Without the notes, the raw numbers on the balance sheet and income statement completely lack context. The notes explain the estimates, the judgments, and the policies that actually make those raw numbers understandable to an investor. Building these notes requires a massive disclosure checklist. I mean, you have to detail disaggregated revenue under ASC 606, showing exactly where the money comes from by product or geography. You need segment reporting under ASC 280, income tax rate reconciliations under ASC 740, lease maturity schedules under ASC 842, and the fair value hierarchy under ASC 820. It's an immense amount of qualitative and quantitative data. In fact, this checklist is so comprehensive, it is pretty much always reviewed heavily by both legal and tax departments before the financials are ever issued. The final piece of the notes is addressing ASC 855 subsequent events. Look, the period might officially end on December 31st, but what happens if a major event occurs in January, right before the financials are actually published? Well, here is the critical distinction. If the condition for the event actually existed at period end, it's a recognized event, meaning you have to go back and adjust the financial numbers. But if the condition arose totally after the period ended, it's a non-recognized event. In that case, you don't touch the math at all, you simply disclose the event in the notes. So, the crucial takeaway here is that true financial literacy requires an understanding of this entire assembly line. As we wrap up this explainer, I want to leave you pondering this provocative thought. Do the numbers ever really tell the whole story without the notes? We've seen how the raw trial balance is molded into the balance sheet, flows into the income statement, and rolls forward into equity. But it is those notes, the disclosures, the policies, the subsequent events, that breathe actual meaning into the math. I hope this deep dive into the mechanics of GAAP financial statements helps you view that final blueprint in a completely new light. Thanks so much for joining me today.